Hi everyone, welcome back to Excellent YouTube channel. My name is Soh. In this video, I'm going to share with you about understanding the three assumptions of technical analysis. As we know that technical analysis is a trading discipline used to evaluate investment and identify trading opportunities by analyzing statistical trends gathered from trading activities such as price movement and volume. Unlike fundamental analysis, which attempts to evaluate a stock's value based on business results such as sales and earnings, technical analysis focuses on the study of price and volume. So, if you are an advocate of technical analysis, then these are the three assumptions of technical analysis you must know, as they are the foundational principles that are important to technical analysis. Click on the subscribe button and turn on the notification bell so you won't miss any informative and educational trading videos we are producing for you in this channel to help you improve your game as a trader. So let's get started. Technical analysis has three main principles and assumptions. The market discounts everything, prices move in trends, and history tends to repeat itself. I will explain it to you in greater depth later. But first, before we get into the three assumptions of technical analysis, first we must know what is an assumption. This is important because without the understanding about assumptions and the value of assumptions can provide, then the theory used will become invalid. Assumptions are statements generally accepted as a given truth without any proof. Assumptions help us to navigate the world around us, and it simplifies the process by giving us a ready-made foundation which is universally acceptable and easy to understand principles. In order to use a theory, the assumptions must be accepted by the user, as assumptions set the foundation for the application of a particular set of theory. So which is why for those users of technical analysis, it is important for you to understand these three basic assumptions. Now let's get into the three assumptions of technical analysis. Assumption number one, the market discounts everything. Now technical analysis assumes that everything happening in the market that could affect the stock or an index, whether it is company's fundamental to broad market factors to market psychology, is reflected into the price already. Well, basically it means that the price will tell you everything you need to know about the company without you having to look at the fundamentals. The only thing remaining for you to analyze is the price movements. Users of technical analysis claims that price actions should reflect the shift in supply and demand for a particular stock or index in the market. If demand exceeds supply, price should rise. And if supply exceeds demand, then price should fall. This action is the basis of all economic and fundamental forecasting. Technical analysis users then turn this statement around to arrive at a conclusion that if prices are rising for whatever specific reason, then demand must exceed supply and the fundamental must be bullish. However, if the price falls, the fundamental must be bearish. So for example, if you notice the price of a certain stock and see that it's gradually going down and it keeps taking a severe hit each and every time the company announces their earnings, well, you can fairly assume that this price action that the company just might not be doing well to sustain itself and they are constantly taking a hit on the earnings as well. The second assumption of technical analysis is prices move in trends. Users of technical analysis expect that prices even in random market movements, will show trends regardless of the time frame being observed. In other words, a stock price is more likely to continue a past trend than move unpredictably. Most technical trading strategies are based on these assumptions. You can have a look at this chart where the price may move randomly day to day, but given time, prices will tend to move towards a particular direction, whether it is an uptrend or a downtrend. That is why trade with the trend is the foundational logic that technical analysis is primarily based on. The concept of trend is absolutely essential to technical trading, because the whole purpose of charting the price action of a market is to identify trends in the early stages of their development, so that you are able to take advantage of the changes in trends. In fact, most of the techniques used in this approach are trend trading in nature, meaning that their intention is to identify and follow existing trends. And lastly, the third assumption of technical analysis is history tends to repeat itself. Technical analysis users believe that history tends to repeat itself because of the repetitive nature of price movements is often attributed to market psychology, which tends to be very predictable based on emotions like fear or even excitement. Much of the body of technical analysis and the study of market actions has to do with the study of human psychology. Technical analysis uses chart patterns to analyze these emotions and the subsequent market movements to understand trend. So chart patterns, for example, which has been identified and categorized over the past 100 years, they reflect certain pictures that appear on price charts. So these pictures reveal the bullish or bearish psychology of the market. Since these patterns have worked well in the past, it is assumed that they will likely to continue to work well in the future. And they are based on the study of human psychology, which tends not to change very much. And another way of saying that history tends to repeat itself is that the key to understanding the future lies in the study of the past. This is one of the most important things to observe in the market as a trader, because all the market participants are people like us, and in certain situations you might notice that everyone might react in a similar way. That's about it regarding the three basic assumptions of technical analysis. The first is that the market discounts everything. Second, they expect that prices, even in random market movements, will show trends regardless of the time frame being observed. And finally, they believe that history tends to repeat itself because of the repetitive nature of price movement is often attributed to market psychology. If you're a user of technical analysis or intends to apply technical analysis in your trading, then you need to understand these three assumptions deep down. So that's it. I have shared with you the fundamental principles of technical analysis that you need to know in learning and using technical analysis. If you find this video informative and useful to you, please share this video and give us a thumbs up. And don't forget to click on the subscribe button and turn on the notification bell. Until next time, this is CY Soh wishing you good luck and good trading.